let's look at the required for Part A. It says refer to 1.1. You are required to discuss the effects that these emoluments or payments have on the income, income of Sammy, and that's for the purpose of income tax, for the year ended 30 November 2019. You're required to provide explanations and references to the Act to support your answer. Income, remember, means gross income less exempt income. That's a definition from Section 1. It's important because it means you have to then discuss gross income and exempt income. And this is in 1.1. Now, I'm not going to write out anything here. We'll talk about it. 1.1 is all of the information here. So the first thing is, let's talk about whether or not an amounts were included in gross income. So how do you know if an amount is included in gross income? It's if it meets the gross income definition or if it's one of the special inclusions. Right. That is when we include it. Now, if you receive any income for employment, that gets included as a special inclusion in terms of paragraph C of the gross income definition. So that's 52,000 rands. You don't test against the definition. The special inclusion makes it that it's not a question. She received 8,500 rands per board meeting. That's again for services rendered, paragraph C. The trick here, the one thing they try to trick you is to try and see if you know if she'll be taxed on it, because the meeting took place on the 28th of November, but she got paid on the 10th of December. Remember, gross income is the earlier of receipt to accrual. The 28th of November, when she's still a resident, that is when it gets included, when she gets unconditionally entitled. If you remember it's a Geldenhuys case, you could potentially get a boson mark in the exam. Should only be bonus marks, guys, for court case names. It's the principles that are important. Sammy is a mother of a 6-year-old daughter. As a single mother of a 6-year-old daughter, she gets 24,000 rands bursary for her. Is this exempt? That 24,000 rands will be included in her gross income. It's not exempt in terms of Section 10(1)Q because her remuneration proxy exceeds 600,000 rands, remember. So 24,000 included, but no exemption is available. Right, then she received this 250,000 rands relocation benefit. It is exempt in terms of Section 10(1)NB, except for the renovation costs. Okay, so it will be exempt. There are lots of marks available in this, guys. In this case, only 5 marks. Right, question number 2. Refer to note 1.2 and its subsections. You're required to calculate any donations tax payable in respect of the events, and you're required to clearly indicate the date, sorry, not that date, the date on which any donations tax is payable. You may assume that the total value of donations made by Sammy in previous years of assessment amounted to less than 200,000 rands. Okay, so why are they telling you this story about the 200,000 rands, guys? Okay, why 200,000 rands? Well, 200,000 rands is not really the issue for us. Okay, I'm just quickly finding it for you. Please remember to go and look at Section 64. Section 64 says, if you've made 30 million rands of donations in the past, anything above that is at 25% rate. The fact that she's made only 200,000 means that her donations tax is at 20%. Okay, so let's go and see in question 1.2, what was subject to donations tax? There were 2 situations where there were donations. In note 1.2, there was a donation of the house to the daughter. But this was when she was a non-resident. So there's no donations tax as a non-resident. Okay, that's the first thing I want you to see. Okay, so this is just a rough calc what I'm doing here, or a rough work. House in SA, I'm going to write here, date of donation. This is just something I want you to keep in the back of your head. House in South Africa was sold on the 29th of February 2020. What else was donated? She donated shares to her daughter on the 1st of April 2019. Remember, why am I writing this down? I want you to see. When you are doing donations tax, remember you need to do it in order. So this comes first, this is second. Okay, so when we do donations tax, you start with the shares. And this is 1 April. Was it 1 April now? Yes, 1 April. The donations tax, if there's any, the due date will be 31 May 2019, end of the next month. Right, the value in this case, so let's do the calculation. The shares were worth 3.673 million. She donated 40 out of the 100,000 shares. So 40 out of 100,000, and the 100,000 is worth 3,673 million. So that gives us 1,469,200. Because she's a natural person, she qualifies for section 56(2)(b), 100,000 rands annual exemption or exclusion. So it's 1,369,200, and you can call this the net value. You need to always clearly show your donations tax rate. There's a mark usually for that. So this gives us our donations tax of 273,840. So we did the shares first because it happened on the 1st of April. The next one that we're now doing is the house in South Africa. Right, in this case there is no donations tax. Sammy is not a resident. Remember, she became a non-resident 1 December. This happened on the last day of February. So after that date, she's no longer a resident. Therefore, it does not apply. Alright guys, then we do question number 3. And there's a bonus question as well. Now I'm going to do both of these at the same time, you'll see. So, question 3. Refer to note 1.2 and its subsections. Calculate the effect that these events or transactions have on the taxable income for the year of assessment ended 30 November. So this means this year of assessment runs from the 1st of March 2019 to the 30th of November. Why is it a short year? Because of section 9H. And this is whilst she is a resident. You're required to show all calculations and provide explanations where amounts have no effects. Right, then I just say this bonus question, guys, doesn't form part of the mock test. Refer to note 1.2. Calculate it for the effect that these transactions have for the year of assessment 1 December to 29 February. So you see that's now just the rest of this 12-month period. And this is again because of section 9H, because it says once you are a non-resident, you start a new tax year. You are required to show all calculations and provide explanations where amounts have no effect. Okay, so here we go. So this first one is 1 March Right. This is when this person is a resident. This next period is 1 December 2019 to 29 February 2020. And here she is a non-resident. In both these instances, we are going to use headings that says description, calculation, / explanation. So you can do this at the top of your page. CGT and rands. Okay, so you'd have the same headings basically. I'm just doing it to make it a little bit clear for myself. Okay, so let's go and party with this now. So they say we only need to look at the notes from 1.2. So it's the notes for the table. So 1.2.1 is the house in South Africa. So again, remember now, this house in South Africa, she had it until the 29th of February when she donated it. So this means, if we look at our time period, she had it from the period from the 1st of March until the 30th of November, which is our one period when she was a resident. She owned it and she used it as a primary residence. She then emigrates, so we have to consider section 9H during the period when she's a resident. It will not apply because it's immovable property in South Africa, if you recall. Right, the rental income she then starts receiving after she became a non-resident, and that's also when the donation takes place. So let's actually do it step by step. So let's start with this first one. So this is when she's a resident, 1st of March to 30 November. Okay, so first I'm going to write also here, rentals, and that is not in this period. So I'm just trying to show you we don't consider it for this period because it only starts from the 1st of December. What else happens in this period? She immigrates. Section 9H. In this case, it is not applicable as this is immovable property in South Africa. In South Africa, and the reference to that is section 9H4 if you want it. So I want you to see for that house in South Africa, nothing happens whilst she is a resident. She hasn't disposed of it, she's not earning anything. Right. Now I'm jumping to when she's a non-resident. Make sure you see this period over here, 1st of December to 29 February, 1.2.1. Right, there was rentals that she earned, and the rentals she earned was from December to February because she had it the whole time. It is from a South African source. That is why she gets taxed on it. She's a non-resident. Non-residents only get taxed on income from a South African source. It's 12,000 rands a month, 3 months. So 36,000 rands in our rands column. What also then happens? During this period, she donates the house. Donation of house. So this is a disposal. So we have to calculate CGT. Okay, so let's do it. So the first thing is, she is treated, if you donate an asset, you are treated as if you sold it, in terms of paragraph 38, at its market value. The market value on the date when she donated it was 2.2 million rands. The base cost, in this case, is very simple. It's just the 1.4 million rands. Nothing else throws it out. Nothing else is given there. So this gives us a capital gain, 800,000. Now I'm going to remind you, that 800,000 rands capital gain is the capital gain for the period it was used as a primary residence plus not a primary residence. Why is it? Why is it when I say it? Because the proceeds is on the 29th of February 2020 and the base cost is on the 1st of, when did she buy it? 1st of August. 1st of August 2012. Okay. So I want you to see, that's the two dates there, the two values of this property. So again, if I just put it down like this, 1 August 2012 to the 29th of February 2020. Remember what we said here. 1 August 2012 to 29th February 2020 is 91 months. For 3 months, the 1st December to 29th February. So this period after she becomes when she's a non-resident, for this period, it's 3 months. It was not a primary residence. So, if we now go, this 800,000 over here is just for the period it was a primary residence, and for a period it was not a primary residence. So the first thing we have to do is we have to say less period not used as primary residence. And that is 800,000 times 3 months out of the 91 months. So that is 26,374. That is for the period she rented it out. That immediately goes into my CGT column, guys. Can you see my CGT column? She's going to get taxed on it. This leaves us with the capital gain on the primary residence. Sorry. So of that 773626, you can now get the primary residence exclusion on that, limited to 2 million. It's the full 2 million is available, guys. You don't apportion this one. Please don't apportion it. And I'm just reminding you that this is, paragraph 45. So that full 773626 will be eliminated. So that gives us our capital gain. There we go. Right. So that is 1.2.1 done. Then we have 1.2.2. So this is the house in Canada. So what basically happens with the house in Canada, guys? What happens with the house in Canada is she gets rentals from her aunt, for the period that she was a resident. And then when she immigrates, there's a deemed disposal, because in terms of Section 9H, remember, just in case you've forgotten again, in terms of Section 9H, when you immigrate, there's a deemed disposal of all of your assets at market value except for those assets. That's not in the house in Canada, it's not in South Africa, so it doesn't apply. Okay, so let's do it step by step. So we go to when she's a resident, 1 March to 30 November. It's going to use a different color here to distinguish between these. So 1.2.2. So this is now for the period that she was a resident. She earned 25,000 rands a month rental. So this is March to November. 9 months. 25,000 rands times 9. 225,000 rands goes into her rands column. Then on immigration, Section 9H will apply here. So deemed disposal at market value. So let's go. So the first thing is the proceeds. So section 9H says it must be market value. What is the market value on the date of immigration? It's given to us in this table as 3.1 million rands. So the proceeds, 3.1 million rands. The base cost, £2.1 million. That's a capital gain. It wasn't used as a primary residence up until the 30th of November. Remember, guys, this happens on the 30th of November. Wasn't used as a primary residence. There's no primary residence exclusion. It just gets included. Right, now we go to when she was a non-resident. Non-resident. What happens in this period? Remember, she still owns it, so don't now think she's really disposed of it. She hasn't, she still has it. We know she has it. She's treated as if she sold it. I'll remind you. She's deemed to have disposed of it at market value and then bought it back at market value. So she's just treated as if you bought it now. So there's no effect when you buy the asset, nothing happens. But what does she receive? She receives 8,000 rands rent a month. But this is not from a South African source. So there's no gross income. It's not from a South African source. So there we go. Then we have question number 1.2.3. So let's see what happens in 1.2.3. When she is a resident, she is treated. What happens when she's a resident? The first thing is she receives this dividend. Let's just actually get that out of the way. Right, so this is now when she is a resident, guys, when she's a resident. What do they say about the dividend? 16 rands 50, 25th of March, that's when she still owned 100,000 shares. So that is why she gets the full 100,000. Section 10.1k. Right, dividends are exempt. Okay, then what else happens? She donates 40,000 of the shares on the 1st of April. Donation 1 April 2019. Now remember what that means. This means proceeds in terms of paragraph 38 is the market value at that date. So the market value of 100,000 shares at that date is 3673. So she is treated as if she sold 40 out of 100,000. So 3673 times 40,000 over 100,000. So 40%, as you can see, 1,469,200. What is the base cost of these shares? She inherited from her grandmother when the market value was 27 rands 45 each. So she inherited it. So I'm just going to write it there so you can see where it comes from. Section 9HA. You use the market value of the shares on the date of inheritance. Remember, we're looking at 40,000 shares here. The market value is 27 rands 45. That gives us 1098. So what's the trick here now? You have to remember this is a donation. And can you remember when we looked at question number 2? We paid donations. So question number 2, we pay donations tax on these shares. If you pay donations tax, paragraph 22 must be considered. Paragraph 22 says M minus A over M times D. M is the market value, 1,469,200. A is everything else that's in base cost. So the 1098 over M, so 1,469,200, times the donations tax that you paid, 273,840. Right, that gives us 69187. So our base cost is the sum of those two amounts. Right, so this gives us a capital gain on the 40,000 shares that were disposed of 302,013. And that goes into your CGT column. Right, then what else happens? So now she's disposed of on the 1st of April of 40,000 shares. So she still has 60,000 shares that belong to her. What happens to her next? She then gets a dividend, which we've already seen. Well, the dividend actually happens before that, so sorry. So she still has 60,000 shares. What happens then? Section 9H takes place. So she needs to be treated as if she sold those shares at market value. So this is a tricky one. Two disposals right after each other. So immigration then applies, section 9H. So the proceeds is now 60,000 shares, because that's what she has left on the date of immigration, the date right before, which is the 30th of November. On the 30th of November, the shares are worth R39.85 each. So that is our deemed selling price. Right, so 2391. Our base cost is, again, remember she inherited it. So in terms of section 9HA, these are now the base cost of 60,000 shares, and she inherited it for R27.45 when it was 27.45. So 1647. I'm just showing you now, guys, paragraph 22. Remember, there was paragraph 22 over there. Paragraph 22 is not applicable here. Why? Because she didn't donate these 60,000 shares. This is just a deemed disposal taking place in terms of section 9H. So this is the capital gain. 744,000 rands. And that goes into my CGT column. Right. Then what happens after she immigrated to those shares? Anything that happens after 1 December 2019? Nothing. So when she's a non-resident, for these shares, nothing else happens. Nothing happens. 1.2.4 is then the fixed deposit at UPSA. Okay, so the first thing I want you to see is for the period she's alive, when we look at interest, guys, we should usually use days. That is 275 days. The period then when she's immigrated to 29 Feb, is 91 days. Now, every year students ask me, let's actually just start from the start, guys, how you should do this. When you have to use days, January, February, March, April, May, June, July, August, September, October, November, December. How many days are there, guys? I'm going to do it once. I hate having to do it, but if you're not sure, type in Google, how can I remember how many days there are in each month? And I'll show you techniques. It's 31, 2020 was 29 days, 2021 is 28 days, March is 31, April is then against 30, May is against 31, June is against 30, July is 31. Then you need to remember 30, August also switches around to 31 again, September is 30, October is 31, November is 30, and December is 31. Okay, that's up to 275 days and 91 days because there's 29 days in February 2020. Okay, so what do we do with the interest? The interest works as follows. This is when she is a resident. So the interest is she has 650,000 rands in the bank. There's simple interest of 11%, and this was for 275 days out of the 366, where she was a resident. So 53,723. She is now younger than 65, so her section 10(1)(I) is limited to 23,800. Okay, now here comes one of your tricks. 1.2.4, this is when she's now a non-resident. So this is the interest from December to Feb. 650, it's from a South African source because it's paid by South African bank. 650,000 times 11% times 91 over 365. $17,777. Now, guys, first thing which you have to consider is section 10(1)(h), which applies to non-residents. It says interest for South Africa is exempt, but it's not exempt if you were in South Africa for more than 183 days in the last 12 months before this. She was a resident. So she was in South Africa more than 183 days in the preceding 12 months. So thus, this is not applicable. Then she can use section 10(1)(I). Now, I know we are doing these 2 periods of time, and section 9(h) says that when you, up until the date when you become a non-resident, is 1 year, and then another year of assessment starts. And remember, it's these short dates. So let me just take you back. Okay, so one tax year ends on the 30th of November, so there's a tax year that runs from the 1st of March till the 30th of November. So that's 9 months. And then there's a new tax year that starts from December until Feb, so that's 3 months. To give us a total of 12 months. Now, I know it's 2 different tax years, but amounts in the Act, like the section 10(1)(I) interest exemption, and abatements and all those things, need to basically be, you can only use it once. So if she's used it all in the 9 months, she's used it all up. There's nothing left in the 3 months. Now guys, this is not written in the Act. This is in fact an area where we don't really know how SARS would work with it, but this is the logic behind it and what they follow in some of the prescribed textbooks and so forth. The idea behind this is, why it's challenging is in practice, there's even no way of doing these short month periods on e-filing. But this is what the Act requires, so practically we'd have to figure out what to do with it. Right, so when she's a non-resident, She's used up to 23,800 for Section 10(1)(I), so there's no further exemption. Now, I'm just making the comment here. This question didn't ask us for withholding tax, but there would be no withholding tax because this is from a bank. Remember, that's that rule. And then the last bit, 1.2.5, this is her furniture. This is a personal use asset, so there will be no effect on that. Now guys, I just want to quickly take you to the solution, just for the rest of the solution to show you. Right, so question 3. So here's everything. So when we get to the end, you add up everything in your, this is your CGT column, runs here. You add up everything in your CGT column. You deduct the annual exclusion of 40,000 rands. That gives you the aggregate capital gain. Any capital losses brought forward you take into account. That gives you the net capital gain. Times 40% gives you the taxable capital gain, which goes into your income. Now, you'll get a mark here, you'll get a mark here. I want you to always write this formula out. Even if your answer here is null, then you say minus 40, it still stays null, 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 and you write 40%. Just in case you messed up, because maybe you think it's null, but the answer is actually 2 million rands, and then you lose out on these 2 marks. So you want to score these marks to make sure you write that. Right, that's for the resident. When you are a non-resident, I just want you to see the difference here. The annual exclusion at 40,000, I made it null here for that same reason. You've already used it up under as a resident. Great. Maybe there's room to argue that it should apportion it, but I wouldn't go into anything like that, guys. Nothing like that, guys. Nothing like that exists. So just do it like we've done it here. All right. That's it for the required. Guys, part B. If you haven't watched this part of part V yet, let me just explain to you quickly. You'll see this question asks you to provide the correcting journal entries for VAT purposes for the month of April. Show all calculation, provide journal narrations. You'll see when I start part B in the recording there, I'm actually going to do the reading and answering it at the same time as we go through it. So it's nice and makes sense to do it in that way. That's it, guys, for this test. If you haven't done it, if you have done part B, go and see that. This is that for part A. I hope it went okay.